What is inflation? Mehangai or inflation is one of the most common refrains heard across the country. So what is inflation? Inflation is the rise in the prices of goods and services. These can be of daily or common use, items such as food, clothing, housing, recreation, transport, consumer staples, or even industrial goods. Inflation means the average price rise over time. The opposite and rare fall in prices is called deflation. Inflation indicates a fall in purchasing power. That is, for instance, a 100 rupee note buys lesser amounts of the same commodity over a period of time. Inflation is measured in percentage. What are the effects of inflation? The purchasing power of the currency falls as goods and services get costlier. When inflation is high, the cost of living gets higher as well. Beyond a reasonable level, inflation ultimately hurts economic growth. A certain level of inflation is required in the economy to promote expenditure, encourage the production of goods and services, and to demotivate hoarding money in savings. As money generally loses its value over time, it is important for people to invest the money. Investing ensures the economic growth of a country. Who measures and controls inflation in India? In India, the Ministry of Statistics and Program Implementation measures inflation. Country's central bank, the Reserve Bank of India, works to limit inflation within a band through its monetary policy by using tools such as the repo rate. The government also influences inflation through its taxation and fiscal policy. Higher MSPs on agricultural products, taxes on petrol and diesel, or even clothes can lead to rise in inflation. A cut leads to a fall in inflation. So how is inflation measured? In India, inflation is primarily measured by two main indices: WPI, or the Wholesale Price Index, and CPI, Consumer Price Index. WPI and CPI respectively measure wholesale and retail level price changes. CPI measures the rise in prices of commodities and services such as food, medical care, education, electronics, etc., which consumers buy for end use. On the other hand, WPI captures the goods or services sold by businesses to smaller businesses for selling further. What are the main causes of inflation? Some of the major reasons behind inflation or rise in prices are high demand and low supply of goods. This creates a demand-supply gap which leads to hike in prices. Excess circulation of money. This leads to inflation as money loses its purchasing power. With people having more money, they also tend to spend more, which causes increased demand. For example, if more people want to buy tomatoes, then the tomato price will rise. Spurt in cost of production causes inflation. For example, soap and shampoo prices may rise if the chemicals used in making these get costlier. This is called cost push inflation. Is inflation bad for everyone? Inflation need not always be bad. Economists believe some inflation is necessary for economic growth. However, beyond a limit, inflation hurts both consumers and economic growth. Inflation also has an impact on the assets you hold. For someone with investments in real estate or stocked commodity, inflation means that the prices of their assets are set for a hike. Those who possess cash may be adversely affected by inflation as the value of their cash erodes. So governments and central banks work towards controlling inflation in an ideal range.